Will that be the case again this time, given all of the uncertainty around the economy? Let's bring in Jason Hunter. He's head of technical strategy at JPMorgan. Find out what he's watching. Welcome back. It's good to see you at this critical time. We're 5,600 right now on the S&P. What are you watching most of all?
So for the S&P 500, the level we've been watching most closely is this 5,500 area for a couple of reasons. Number one, when you look at the November, February price pattern, what in hindsight ended up being a distribution pattern, the technical pattern objective from that was roughly 5,500. At the same time, what's traversed that area even more important, if you look at the SPDR ETF, so obviously an ETF that tracks the S&P 500, if you look at the rolling one-year volume-weighted average price, that historically going back to the late 1990s has been a huge bifurcation zone for the most part for the S&P 500. It either holds it as support, or once it breaks through it to the downside, you see a dramatic pickup in volatility, and then naturally that is your signal that we moved into a more protracted period of correction. So this is a key inflection here that we think people need to pay very close attention to and respect.
I mean, I think people are trying to look for buy signals. That April's historically good. We've had a lot of pain already in a really short period of time, and they're trying to look, at the forest through the trees and see what's out there. How would you assess that?
So I'd say just looking at the chart by itself, we've actually decelerated as we came into that zone. We saw an initial rebound from it in mid-March after some of those pattern-based signals that triggered on our model, triggered. And as the market bounced, we had highlighted this 5,750 to 5,900 area. That's likely where the index would stall out, and that would cap the range for a while. We pulled back into the zone again, and with the bounce that we had yesterday, it actually triggered another buy signal. So just looking at the chart by itself, our base case is we try to hold that here, but we also recognize the bifurcated risk distribution associated with the policy uncertainty as we head into tomorrow.
I'm thinking about the topic that's on everybody's mind, and that's whether this is simply a growth slowdown, a scare, or, I mean, it's undoubtedly it is a slowdown, obviously, whether it becomes something worse, a recession or not, which puts specific sectors of this market on, potentially thin ice. Or if you don't have a recession, maybe a great opportunity, right? Cyclicals is an area where you are really keenly focused on.
Yeah, so we've tried to play, the risks on both sides of it. Because obviously when you have this bifurcated risk with no real certainty on which one's going to turn up, you look for ways to take advantage, cheap ways to trade both sides of that. So, on the downside first, on the bounces up toward that 5,800 on the S&P, what we suggested is looking for ways to hedge a potential, move to the wrong side of that knife, where if we fall off the wrong edge, off the wrong side of that edge. And that's basically long 2-year note, 2s/5s curve steepener, dollar-yen shorts, or a trade we just suggested on Friday, which is a 10-year tips break-even tightener. Those trades should all do well if the S&P were to break to the downside. And the entry levels we've been suggesting, those were all ideal levels where you take asymmetric, risk-reward. Now, on the flip side, you had mentioned cyclicals. That's a market that's been under-owned for at least 2 years because the data has just been soft over that period. And you see base patterns that have developed from December through now for a number of those markets, and basically going long on pullbacks there with fairly tight stops. If things stay somewhat on stable ground, this holds this 5,500 area, that's where the risk reward looks most asymmetric to the upside. And really that's a lot of markets outside the U.S. We favor this non-U.S. equity exposure really from December on the technical side. And a lot of those markets have moved up and certainly have outperformed the S&P over that period.